The stock market is a monster by itself. There are so many things that just are not clear when it comes to the stock market. There are specialists who spend hours and hours and days and years focused on just a couple of stocks, and they struggle to guess where it's going to go tomorrow. If you just take my word for it, you cannot guess or try and predict what's going to happen tomorrow with the stock market. So choosing one stock is very risky because you're not diversified throughout different things. So you could put your money on here and put your money on there, but there's no way of telling what's going to happen tomorrow. So the recommendation I've read up, the recommendation I've heard online is that you put your money onto an index fund. So what exactly is an index fund? What an index fund is that it's a whole bunch of single stocks in kind of one stock. It takes all the stocks or a bunch of stocks and you put into one bucket, and then that one bucket you buy a stock of. If you buy one stock from that bucket, you now have all of those companies in one stock. That's an index fund. Some of them are actively managed, some of them are passively managed. An actively managed index fund means that there's people with degrees and masters and doctorates in trying to choose which companies to put into the index fund and which companies to take out. That means that people are trying to guess what's going to happen tomorrow. Oftentimes does not work. The issue with actively managed index funds is that they have higher fees. Because obviously there's people who are trying to do this, so they have salaries, and then those people who have salaries have bosses, and those people who are the bosses want to make money, and so they are making money off you. A passively managed index fund means that someone has gone, okay, these are the stocks, I'm going to put it in the bucket, and then people can buy stocks of that bucket, but we're not going to actively add or remove. We're going to just leave it as it is. Historically, those have done much better. So the Vanguard Total Stock Market Index Fund is a passively managed fund. Its fees are ridiculously low. You're paying like 0.05%, where some of these actively managed funds can cost you somewhere between 0.5% to even more than 1%. That's digging into your money. If you watch the previous videos and you're like, well, I'm going to save up and I'm going to live on 4% of my money, if you're being charged 1% of the money you've made, you now are having to pay them 25% of your 4%. Because if you're taking 4% and you're paying them 1%, you now only have 3% left. That is a lot of money. 1% might seem like a little bit, but in the long run, it is significant. What is up with this whole Vanguard thing I keep talking about? Already a long time ago, someone, and the first person to come up with the concept of an index fund was the person who made the Vanguard fund. So you might have heard the S&P 500 or something like that. That is an index fund with the USA top 500 companies like Apple and Google and Amazon and all that sort of thing. So the Vanguard Total Stock Market Index Fund is all of the companies in the US stock market. Which means is that if you buy one share of the Vanguard Total Stock Market Index, you now own a little bit of all of the companies in the US. So like I said earlier, you can't guess which company is going to do good, and you can't guess which company is going to do bad. So the reason why the Vanguard Index Fund is so good is that it has all the companies. So you're taking the average of the US economy, well, not necessarily economy, but how each company is doing in the US, and you're taking the average of that, and that is what your index fund is going to perform. So in the last 40 years, it has produced 11% on average. It is not a short-term investment, it is a long-term investment. So don't buy today and then sell tomorrow or sell in a month's time. That is not how this works. This is a long-term investment. If you're buying today and you want to sell in a year's time, it might be down 10%, it might be down 20%. But in the last 40 years on average, it has made 11%. That is very high for the stock market. When we try and choose what we think is going to work or what is not going to work, we are fooling ourselves. To take it for granted from me, you can't tell what's going to happen tomorrow. For instance, if you had put $1,000 on Bitcoin when it first started, people would have been, are you crazy? But today you'd have millions of dollars. But I'm assuming you didn't do that or you wouldn't really be here. But that is risky. Bitcoin could have just disappeared and you would have lost your $1,000. Same thing goes for Apple or Amazon or Google or Microsoft or all these huge, huge companies. If you just take one of them and it crashes, that is a lot of risk. That's why when you just take all of them, It's very easy, it's very simple. You just put money onto this index fund every month whenever you can, and it will grow it on average. Not that previous performance is an indicator of future performance, but that on average it does that well. Even through this recent crisis with a massive drop in the stock market, it is now higher than it was at the highest point before the crash. So guys, remember, this is not necessarily financial advice. This is just me telling you guys something I wish I knew a long time ago. I wish I knew this stuff 10 years ago. I would have been putting money into the Vanguard fund 10 years ago, and that would have been a massive benefit for me today, but I didn't. So I'm trying to start that today. Hope you guys enjoyed this. If you did, if you found this helpful, please share it with your friends. Please hit like and subscribe, and we shall see you in the next video.